All right, today we're going to tackle one of the most important skills you can have for reading any financial chart: support and resistance. Seriously, if you've ever stared at a stock chart and it just looked like a bunch of random squiggles, well, this one's for you. I mean, when you first look at one, it can feel totally chaotic, right? Just this jagged line bouncing all over the place with no rhyme or reason. And listen, if that's how you feel, you're not alone. We've all been there. But what if I told you that underneath all that chaos, there are these invisible levels? Think of them like hidden floors and ceilings that are actually guiding the price along. Getting this one simple idea is, no joke, the key to understanding how markets are structured.
Okay, so here's our game plan. First, we're going to break down what these floors and ceilings actually are. Then, we'll get into how you can spot them. After that, we'll talk about how you can trade the bounces and the breaks, and what happens when those levels fail. And finally, we'll wrap it all up so you can really make this your own foundational skill.
So let's start at the beginning, the floor and the ceiling. We're going to cut through the jargon and get right to the heart of what is really happening on the chart.
The easiest way to think about it is like this. Imagine you're in a room with a basketball. The floor that the ball bounces up from, that's your support. It's a price level where a ton of buyers step in and basically say, nope, the price is not going any lower than this. And the ceiling it hits before falling back down, that's your resistance. That's where sellers take control and put a cap on how high the price can go. And these levels aren't magic. They're not just random lines. They're really just a picture of a classic old school battle. Support is just a spot on the chart where demand from buyers overwhelms the supply from sellers. And resistance is the opposite. It's where the supply from sellers is just too strong for the buyers to push through. Okay, now here is where it gets really, really cool. It's this idea called role reversal. So when a price finally gets enough power to smash through a resistant ceiling, guess what? That old ceiling very often becomes the new floor. It's like the whole market's psychology flips, and traders who were once selling at that level now start buying there, defending it from above. All right, so we get what they are, but how in the world do you actually find these so-called hidden levels on a real chart? Let's roll up our sleeves and get practical with the tools of the trade. So there are a few really solid ways to do this. We're going to look at spotting old highs and lows, using some dynamic tools like trend lines and moving averages, and then we're going to cover what I think is the single most important confirmation tool out there: trading volume. Honestly, the simplest way to start is just look to the left on your chart. Where has the price turned around before? A place where it peaked is a potential ceiling. A place where it bottomed out is a potential floor. And here's a golden rule. The more times a price comes down to a level, touches it, and bounces off, the stronger and more important that level becomes. But you gotta remember, these floors and ceilings aren't always perfectly flat. I mean, think about it. In a healthy uptrend, the floor itself is rising. You can actually draw a sloping line connecting the lows, and that becomes a dynamic support. And it's not just trend lines. Other tools like the 50-day moving average often act as a kind of moving, curving floor that the price will bounce off of again and again during a strong trend. Now, this part is absolutely crucial. Let's talk about volume. Volume tells you how much conviction, how much oomph is behind a price move. If a stock drops to a support level and then you see a huge spike in volume as it bounces higher, well, that's a powerful sign that a whole army of buyers just showed up. High volume is like someone shouting from the rooftops that, yes, this level is the real deal.
So we've got the theory. How does this translate into actual practice? Let's check out how different kinds of traders and investors use this exact same knowledge to make decisions.
It all just comes down to your time frame. A day trader is looking at charts on a minute-by-minute basis, trying to scalp quick profits off these tiny little intraday floors and ceilings. Then you've got your swing trader, who's maybe looking at a daily or weekly chart, trying to capture those bigger swings from a major support level up to a major resistance level. And then way, way zoomed out, you have a long-term investor. They might use a massive multi-year support level to decide when it's a good time to buy. See? It's the same concept, just on a different scale. Okay, this is where things get really fun and, a little dangerous. Those floors and ceilings, they don't hold forever. So what happens when they finally give way? Welcome to the art of the breakout. So how can you tell if a level is starting to get weak? Well, you gotta be a detective. You look for clues. Is there a big surge in volume pushing into it? Is there some big news event that's acting like a battering ram? Has the price been knocking on that door over and over and over again? Sometimes you'll even see the price get really quiet and tight right underneath the level, just coiling up and building pressure like a spring. Those are all signs to pay attention to.
So you see the signs, right? The pressure is building, and then boom, the price just smashes through that ceiling that's been holding it down for weeks. This is that classic breakout moment that traders absolutely live for.
But wait, just as you jump in, all excited for this big new move, the price suddenly stalls, reverses, and dives right back down below the level it just broke. And you have to ask yourself that one crucial question. Was that real? Or was it a trap? This is what we call a false breakout, or a fake out. It's a nasty little move that's designed to trick people into jumping on board right before the market slams the door in their face. You'll hear traders use slang for it, like a bull trap for a failed upward break, or a bear trap for a failed downward one. So how can you even begin to tell the difference? Well, there are no guarantees, but you can look for clues. A true breakout usually happens on high, convincing volume, and the price doesn't just poke its head above the level, it closes firmly beyond it. A false breakout, on the other hand, often happens on kind of weak, unconvincing volume. The price just can't seem to hold on, and it quickly collapses back down, often ending in a really sharp reversal. Phew. Okay, let's bring all of this home. What are the most important things you need to remember as you start to use this new foundational skill? If you remember nothing else, remember these 3 things. Number 1, levels are zones, not laser-thin lines. Think of them more like a thick crayon mark. Number 2, volume confirms the strength of a move. Always be a little suspicious of a big price move that happens on low volume. And number 3, and this one is non-negotiable. Because fake outs will happen, you always need to have a risk management plan. And you know, that really is the best way to look at this. You're not just memorizing some rigid technical rule. What you're really doing is learning to read the story that a price chart is trying to tell you. You're starting to finally understand where the big battles between the buyers and the sellers have been fought. So the next time you open up a chart, don't just see a random squiggly line. Look for the floors. Look for the ceilings. Ask yourself, where are the battle lines drawn? Now that you can actually see them, what story is your chart telling you?